Folks, welcome to Extraordinaire.com. Hola, ¿cómo estás? Namaste, salam, konnichiwa, ni hao to all my friends all over the world. Welcome. So in today's video, I'm going to share with you how to save taxes by being in real estate. If you own a property, if you're willing to invest in a property, if you are thinking of buying a property in future, if your friends own a property, this video is for you because real estate has massive tax implications. Folks, it's not what you make, it's what you keep. So keep that in mind. Knowledge is the new currency, folks, and I'm here to give you that knowledge, okay? So if that interests you, stick around to find out more. Real estate, investing in real estate, buying real estate, owning a property, residential, commercial, vice versa, has massive tax implications. How? Why do you think all these billionaires, Mark Cuban, Bill Gates and Warren Buffett, all these folks, they also have money in stocks and bonds and all that. But why do they keep buying more real estate? There is a reason for that. Amazon.com is a massive real estate business. They're owning massive amounts of storage, right, to ship you all the products that you order every single week. I do that myself too. If you buy certain stocks and you make, let's say, $30,000, have you really made $30,000? I think not. I think not. Now, here's why. Because you're going to be paying 15, 20, 30% in taxes on that stock gain. So don't come to me and tell me that I made $30,000. No, you didn't. You made maybe 20, if you're lucky, possibly $15,000 by risking $30,000 of your own money. And that's the difference in real estate, folks. Real estate has massive amounts of loopholes that you can use, your friends can use, you can teach your family. So these loopholes will help you save more money. It's not what you make, it's what you keep. So you gotta keep the money you're making to accelerate the path to success and to wealth, and more importantly, for me personally, generational wealth. So if you buy a house and you live in the house as your primary residence, now if you have that house as a primary residence, let's say you live in the house for 3 or 4 or 5 years, off those 5 years, the 2 years you live in the house as a primary residence, and you make any money off that house and you sell the house, let's say you made $200,000 profit, right? Because you bought the house for 300, now it's 500, for example, right? So guess what? You don't have to pay any taxes on that extra $200,000 that you built in equity that you never had. And that's the beauty of real estate, right? It is called ownership of use test, okay? Now, what happens if you're in a property, you live there for 2 years, but you move to another property and then you're living there for 2 years? That's fine. You can still charge the previous amount you gained from the previous house when you sell that house and then put that money into your new house. So you might ask, what if I live in the house for only 20 months, not 24 months? Well, then there comes the loophole number 2, which is 1031 exchange. Now, 1031 exchange is a fancy name, okay? In simple words, it's nothing complex. And here's what it is. You buy a house, and the condition is within 45 days, you have to find another house and identify that this is the house I'm going to buy in future, okay, while you're selling your house. Once you identify that house, you still have about 180 days to purchase that house and do the closing of the house, for those of you who know what closing is. And if you don't, I can explain later. I'll put the description in the bottom. But so that's the stipulation, but there's more to it. So 1031 exchange means that the new house that you bought, okay, you're selling your old house, you bought a new house. The new house has to be either at least $1 or more in value than your current house. And this whole process, okay, identifying a house in 45 days and then buying it in 180 days is called 1031 exchange. One hand takes it to the other hand, okay, and you don't pay any taxes. So there's some limits to that, okay? And that's what people are not telling you on the internet here and on YouTube videos. There's some limits to that, okay? If you're single like myself, well, you can only gain up to $250,000. Beyond $250,000, you're gonna be paying taxes, okay? If you're single. Now, if you're married, there's some benefits of being married, folks. If you're married, the amount doubles because there's 2 of you, right? So now it's $500,000 before you pay any taxes. So guess what? This is the beauty of real estate. Where else in the world can you make money off any stocks or bonds or investments up to $500,000 if you're married and not pay any taxes? This is insane. This is beautiful. This is why you need to get into real estate and understand. Okay. And if you're fearful, if you think you don't have the money, you don't have this, don't worry about it. You can always reach out to entrepreneurextraordinaire.com or contact me, DM me, and I will help you. Our goal is to help succeed together, remember? Okay. Now on to number two. Number two is depreciation. What is depreciation? Okay. I'm going to simplify the whole concept for you because people talk about appreciation in many different terms, in many different ways, and it gets silly. You know, let's say you have a business and you bought a machine that's $10,000. Well, that machine will depreciate every year for the next 10 years. So in tax terms, you can deduct up to $1,000 every single year for the life of the machine, which is 10 years. That's how simple that is. In real estate terms, what this means is if you have a house, let's say you have an investment property, you can depreciate that house over the life of the loan, okay? Which is usually 30 years, but here's the trick, okay, that nobody's telling you on the internet again, okay? It's 27.5 years. Does it really matter for residential, by the way? Does it really matter? It doesn't matter. For 27 years, you can keep depreciating the full value of the loan. Now, here's another thing people don't tell you on YouTube channels, and there's all these fake people on YouTube that really upsets me, pisses me off. These are YouTubers. They have never done real estate. They have never done investing. They don't have any assets. I personally have over $1.5 million of my own money invested in real estate. I've been doing this for over a decade, folks. So here's the thing. The amount that you can depreciate is the value of the house, not the value of the land. Those are two different things, okay? Don't let anybody just tell you and give you generic information. This is the problem with YouTube. People give you generic information. You just write down the top 10 tips of this and that, and you go and start to execute. That's not gonna work. You need to be very specific in what you're doing, okay? If you're not specific, you're going to fail and get in trouble. So watch out for those people giving you wrong, false advice, okay? So you can only depreciate those $300,000, which is the value of the house, not the land, okay? Not the land, just the house. Over 27.5 years for residential. Now, if you're commercial, it's different. It's actually 39 some years. I don't have the right number, but yeah, I think it's 39 years. So think about this. There's a trick to it, folks. People who have a lot of money who are doing commercial properties, buying big apartment buildings, you know, they can go on forever. So the next tax loophole is this, right? You buy a property, okay, a rental property, you own one property or 20 properties or 30, whatever, like myself. You can then depreciate a lot of other things, not just depreciation of the property, okay? For example, somebody, like a friend of mine just told me, like, man, I hate being a landlord. Somebody, you know, all these people, they call me and the toilet broke down or the roof was leaking and I have to go fix it. Well, so freaking what? So what? Go fix it, send somebody to fix it. Guess why? Because that amount is tax deductible. You can write off the repairs in the property, for the toilet, for the roof. You can write those things off. And folks, please try to understand, these expenses are write-offs, okay? It's not money out of your pocket. You can get that money back, okay? So keep that in mind for your rental properties. Not only that, you know, you have attorney fees, okay? You have the interest on your property that's also tax deductible, okay? You have any attorney fees, legal fees, closing fees, you pay any points on a hard money loan. You can also write that off. How cool is that? How powerful is that? Where else can you buy a piece of stock or bond or, you know, loans or whatever that you get to write off the acquisition fee? So that's pretty cool, I think. And folks, the benefits don't stop there, okay? If you assume the debts of a seller who sold you the property, that's also tax deductible. you know, property surveys, attorney fees, if your tenant sues you, that's also tax deductible. I mean, where in the world can somebody sue you and you can write off all that amount that you spend on legal fees? But in real estate, you can't do that. Folks, saving money through real estate is fun, okay? It's keeping money in your pockets, okay? And that's what I call it. So learn those tricks. Hopefully this video was helpful for you. We're giving you here solid information. You can check my profile out. You can see my background. But anyways, real estate is fun. Please subscribe and like to our channel so you can get more videos. Again, last but not least, thank you for joining, giving us your time. Your time is valuable, and we understand that. And that's why we have information on Facebook, on Instagram, LinkedIn, obviously YouTube, and more importantly, entrepreneurextraordinaire.com. Okay, so hit us up. Thank you very much. Have a nice day.